You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music can mean only one thing. It is Education Wednesday, and it is time for Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this ever-exciting network. If you like what you hear for this program or for anything else we do, pretty much hitting you multiple times a day out there on the network these days. Make sure you keep those reviews coming in your platform of choice. New folks discovering us all the time. You want to keep that flow going. Let them know there is a safe and reliable outlet out there for options information and education and analysis, all the other fun stuff that we do. And of course, keep those questions coming. We do love to hear from you guys. And let's see who we're hearing from today. I am pleased to say once again, I am joined by the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring and author of a few options books. Mr. P, welcome back to the program, sir.
Hey, Mark, it is always great to do this.
It is always great to do this, and it's always great to get together for a little bit of the old options drills.
Hell in boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me?
I love that one. So festive. It always gets me marching in place, feel like it's 4th of July or Veterans Day or something here. It's always a celebration here on the old Options Bootcamp program. But Options Drill is going to do something a little bit different. We're going to explore some concepts we talked about before, maybe how to apply them. In this case, a very specific scenario. This one, well, first off, we touched on it last episode. We were talking about maybe some ways things you should understand, of course, and things you needed to know before you start trading options. But that kind of dovetails well into this actual next question from Sisters, 2 Z's. They say noob alert, exclamation point. I don't think you're a noob, Sisters, but we will hold off. We don't judge our listeners. We out here. We enjoy and welcome all here. They say digging the show and still learning. Couple of quick questions. Number one, are all of Dan's books on Amazon? Any Kindle or Audible versions? Parentheses here. Hint. Maybe Mark could read the latter. He has a sweet voice. Well, thank you, Sisters. That's a lot of work, audiobooks, but it could be kind of fun. And then the other part of their question, I think I have a grasp of the basics. What do you think is the best first trade for a newcomer to options who's only traded stocks? So, Dan, since you are mentioned as the author of said options tomes, I will let you go first. First off, are all of your books on Amazon? Are there any other versions? And then B, this is a good kind of options drills discussion topic today. This is, I think, a scenario a lot of our listeners find themselves in. They are preparing to, or perhaps have just made, their first options trade. So what do you recommend in that scenario as well, sir? A twofer, Mr. P.
Aha. Well, yes, all my books are on Amazon. If I'm not mistaken, that is the the best price you can find it online. And so probably just go there. I know there is a Kindle version. I don't know if there's an Audible version, to tell you the truth. My publisher takes care of all that, and just I don't know what they do, but yeah, you can go and buy it on Amazon, and I'd really appreciate it. When you're done, if you want to review it on Amazon for me, that would be splendid. I'd really appreciate that.
What about your sweet guide to playing bass, volumes 1 and 2? Are those still available on Amazon as well? Or are those only special editions out of print?
Yeah, that's right. I've got the box set on 8-track only, because I think 8-tracks are going to make a comeback. I really believe that.
I'm with you on that. I think I should stock up on that, and I think that'll be a good little side hustle for us. What do you think?
Yeah, definitely. As far as the ideal first option trade, I like the old KISS method. Keep it simple, stupid. I was trying to think of a nice word for that, but we're traders. We don't have to be nice, right, Mark? No real politics in trading. Just, go and make money, and it doesn't matter. So keep it as simple as possible when you make your first trade. So things like buying a call, or if you think the stock might go down, buying a put. I mean, probably buying a call if you're coming from a stock trader standpoint. Now, I will tell you, and I've said this before on the show, that buying a call, like if the only trade you know how to do is buy options, like you're probably going to lose money in the long run. Like you want to advance, as soon as you can, to slightly more sophisticated trades that give you a greater advantage, like spreads, vertical spreads, time spreads, where you can put more things in your favor. But, you don't want to start out with an extremely complicated trade that you don't understand. Get your feet wet with something that has a familiarity to you, like, hey, if the stock goes up, I'll make money, and try that out, and then start to dig a little deeper, because there are so many advantages that you can put in your favor when you really understand options and spreads and the Greeks and all that. So, start small and build on it, and you can have a really, really great career.
Yeah, I'm kind of with you. You definitely want to keep it straightforward. I'm glad they say from the perspective of someone who trades stocks, because that's the perspective where we really gear this show around. If you're coming from something else, if you're, a fixed income or a futures person, a little bit different perhaps. But for most of you, you're coming at this from having traded some stocks in your retirement account, maybe in your own personal brokerage account. And now you're taking that leap. Maybe you discovered this show. Maybe you discovered options first, then discovered this show. Either way, you're getting ready to dive, or maybe more accurately, dip your toes into the shallow end of the options pool. Now, I'm kind of with Dan on this. You want to keep it pretty simple. I'm of two minds on this, because I know what's most comfortable to most newcomers to options who've only traded stocks is to do exactly what Dan said. It's pretty much come out and buy a call. That's something they understand. Remember, I've said before, a lot of retail options traders and newcomers, they think primarily directionally. It's hard to blame them. That's what stocks are all about. Stocks are all about direction. They don't have a Vega component or a Theta component, all these other cool things we get to talk about in the options world. Stocks just go up or go down. So they come to options with that exact same mindset. I want my option to go up, or I want the stock to go down. That's pretty much all they think of. And so from that very limited frame of reference, buying a call makes a lot of sense. But as Dad points out, that's a difficult path to be successful on in the long run for a lot of reasons. First off, what I mentioned on the last show, a lot of people get lured to doing that typically right before an earnings announcement. They like Apple. I want to buy some Apple. I can't afford to buy the stock. I'm going to buy some calls that are 10 delta. They're a huge percentage out of the money right before the earnings announcement. So they need an astronomical move to pay off the ridiculous level of volatility that they just purchased. They don't understand any of that. They just know how much they paid for the option. And then, of course, the event happens, the balloon pops, as I mentioned last week, and they lose a good chunk of that, if not all of it, because all that premium goes away. And they don't get the move they do. Or maybe they get a move, but it's not enough. Or they get a pretty decent move, but still, they paid too much for the event premium, and they can't make it happen, so they lose money on that trade as a result. That's why I'm a little bit skeptical of recommending calls to the beginner. I would prefer to see you take that option understanding you're starting to have and apply it to the equity understanding, the equity base you've already built. You already get stocks. You already know how stocks work. They go up or down. So that's why I think people have a little bit more success if they can maybe make that intuitive leap to going the covered call route against their stocks. You keep a stock on. You don't do anything with that. You have a stock on you already like. Maybe it's Ford or maybe Tesla or Apple if you got a little bit bigger bankroll out there. And you say, you know what? I've got 100 shares of this thing or 1,000, whatever it is. And I could sell some options against this. One lot if it's 100, a 10 lot if it's 1,000. Remember your multiplier out there, listeners. And that gives you a chance to do the analysis, the due diligence Dan and I have talked about on the show many times of deciding where you're comfortable getting out. And if you have a level where you're comfortable getting out, you could sell a call there. And then guess what? You get paid for that. Instead of just working a limit order to sell it in your broker, you're taking risk, you're capping your upside on that position, and you're getting nothing for it. If you sell the call, you're getting something for it. You've now created an income stream on your underlying position. Think of that. How crazy is that? So I'd much prefer you to go that route, even though I know the lion's share of you are probably going to go the buy a call route, and usually at the inopportune time, right before earnings or some other time when it's going to be extremely difficult, if not impossible, to make that trade break even. So go the other route if you can, but I get it if some of you like to buy the old calls. Dan, what do you think about the covered call as a starting point for the options trader, sir?
Yeah, that's kind of my second choice too, because it's not really that complicated. You're just adding one thing. And it is like an extension of your long-term investment strategy. So, you're just sort of like adding one element to something you're already doing. So, yeah, I'm okay with that too.
So there you go. A couple ideas. The one you're probably going to do, and perhaps the one we'd prefer you to do, which is the covered call. But hey, write in. Tell us what your first trade is going to be, or perhaps what your first trade was. We like to hear all that stuff. Speaking of hearing from you guys, it is time to open up the floodgates. You guys are deluging us all the time here. So it's time for the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, your portion of the show. Obviously, it's all your show, but you guys really get to directly steer the conversation here. In this part, these are troubled times, so I have to kick things off with a little bit of love. This one comes in the form of a 5-star review from Moogle. Mr. Moogle, I like that. He says, great show. Thanks, guys, for putting this out there in the world. I only wish it was every day. Well, blame Dan. I want it to be every day. Dan says no once a week. So, Dan, there you go. It's all your fault. Now, that would be cool. We're with you, Moogle. It's just other things, other priorities have to intervene here between doing it every day. We wish we could. There's certainly enough demand for it out there. You have to settle for once. Hey, you're getting it once a week. Used to be twice a month in the past, or maybe once a month, or sometimes not at all. You're now getting it in your hot little hands, in your inboxes on your device of choice every week. So, hey, be excited about that. All right, next up, Nellis. Kind of a related question, what we're just talking about here, Mr. P. Nellis wants to know, does it make sense to write covered calls on dividend-paying stocks to increase the yield? Or is that already priced into the value of the options? Yeah, this is a very common practice out here. Obviously, people like income in all shapes and sizes. People usually start by buying exactly what you're talking about, these high dividend yield stocks. Those are attractive to a broad spectrum of the investing public. They're retirees, asset managers, people who like a nice little income stream. And then the light bulb goes off and they say, you know what I could do with these darn income paying stocks is get a little bit more income out of them. And that's where the covered call comes in. So yeah, that's a very common use case. Dan, is this something you explore with your mentees out there, going out and finding high yield stocks already and then adding an income leg on top of that? And do you have any caveats about that you want to pass along to Nellis?
Yeah, a lot of my traders, student traders who are really good with investing, that is exactly what their method is, because you get to kind of double dip a little bit. Now, to be fair, the dividend does affect the price of the option, and so like after the ex-dividend date, if the stock opens unchanged, it falls by the amount of the dividend. which logically makes sense because then you have the dividend and you have the stock price, so you have the same value. But the call price doesn't change. Like, you don't see that benefit when the stock price falls, but that's okay. Like, you're still reaping the theta, and that's like the pricing model calculates it that way so that everything is equitable and everything makes sense. So yeah, like, do it for the theta. Don't get hung up on the dividend. But if you have a good dividend paying stock that you think might not rise a whole bunch and you just want to squeeze a little more out of, yeah, covered calls can be great, man. Totally great.
Well said, sir. Next up, we've got Tim. Just Tim. Tim wants to know, Hola, Tim. So I'm trying to grasp these options still. He says, not sure I really get puts. So you're not alone, Tim, by a long shot here. So I'm buying something in order to sell it later. And the opposite is true if I sell it. I'm selling something that we're really agreeing to buy it later. Also, where does the name put come from? A lot of questions here. There's a reason, Tim, and everyone else out there, why neither Dan nor I recommended your first options trade be a put. Because it does seem, as Tim so eloquently lays out here, to be a little bit of a intuitive leap for people to make when they start really trying to wrap their heads around puts. Calls they come from buying stock usually and being long stock. So a call is analogous to being long stock. They understand that. They can wrap their heads around that intuitively. But as Tim puts it out, the put is kind of the inverse of that. You're buying something to sell something and selling something to buy something. It's very weird and very counterintuitive. So yes, you are correct there, Tim. Obviously, a put gives you the option, which is, of course, the right but not the obligation to sell something at a particular price by a particular date. So through the expiration life of that option, you will have the opportunity, if you buy it, to sell that underlying at that price throughout the entirety of the lifespan of that option. Now, that could make some very useful things. And let's say another repeat, hopefully we don't see it, but another repeat of the March sell-off where everything is getting clipped by 20, 30, 40+% out there. Then having a guaranteed right to sell something at a certain price by a certain amount of time, that could be very useful. And you could see why that would be valuable, and particularly in things like a large index or a large equity, and why people are willing to pay up for those things, particularly now. They have a get out of jail free card, only it's not really free. It's going to cost you quite a bit. So more of a get out of jail expensively type card. And you're right, it gets even more counterintuitive when you flip it on its head. Now you're going to sell a put. So you're selling to someone else the guarantee that they will be able to sell that product at a particular price by a particular expiration date. So now you do have that obligation. Now you are on the hook. Whenever they want to sell it, you have effectively agreed to buy that underlying at that price. So you're right. It is a little bit counterintuitive. One of the reasons why we don't recommend people start with puts, maybe graduate to them at a later date. Also, so Dan, first off, what are your thoughts here from Mr. Tim? And then B, he asks at the end of his question, where does that name put come from, sir?
Yes. So first, yeah, don't worry. There's a reasonably big percentage of people who, when you're first learning about options, puts can feel confusing, man. They really can. So don't worry about that. You're in good company. Think of it like, one way to think of it is like, everybody makes the insurance analogy because it's a pretty good analogy, Like, say you have a car that's worth, who knows what, 40 grand, right? Like, if you totally crash your car and it's totaled, the insurance company writes you a check for 40 grand. It's basically like you're able to sell it to them for 40 grand. Like, or if you have $5,000 worth of damage, they send you a check for $5,000. You're stopped out, you're protected. You can sell it for the value. Yeah, it's kind of a good analogy. So, and you're willing to pay that premium for that insurance policy so that you are protected. So it's kind of the same thing. That said, where does the name put come from? It's because like if you own the stock and you also own a put that you're holding against it, like maybe the stock's at 80, you own the 80 strike put, the right to sell it at 80. all of a sudden that stock goes down a whole bunch. It goes down to 60. You don't want to own the stock that you bought at 80 at 60. You want to sell it at 80 and come out clean. So you're able to just put that stock to somebody else, stick them with it, I guess you could say. So that, and that's where the name comes from. You put the stock to someone.
That'd be a cool new name for puts, the stick it to 'ems. What do you think? People would trade those en masse, I think. That'd be much, much more popular even than puts are now. But yeah, you're right. It's kind of an antiquated, terminology. Oh, it's a put. I put it to you, but that's effectively where it comes from. Let's call them stick it to 'ems on the show going forward. I like that. All right, we got time for a few more here. Elliot Benz. I worked to close my options trade yesterday. The market was 18 cents at 20 cents. I tried to pay 20 cents for 10 and was not filled. I checked the order book, and there was more than 10 offered at that price. What should I do? Do I have to pay through the offer to get filled? Please, with the Z, please help. Yeah, we get inquiries like this all the time. It's kind of hard to diagnose your issue with the scant amount of detail you gave us here, Elliot. My first guess is going to be you don't say what you have on. Typically, when this scenario happens, it's usually a spread, and someone is looking at the NBBO that their broker gives them for that spread, which is, of course, they went to all the exchanges to find the best bid and all the exchanges to find the best offer, and they aggregated it together to create what's called the NBBO, the National Best Bid and Offer. Now, that's nice, and that works pretty well for single leg options. You just want to buy a call or sell a put, you know where you can get it done. The problem with spreads is they get locked into these things called spread books that are limited to a particular exchange. So the NBBO could be showing you this 18 cents at 20, but the market on the exchange where your spread is could be 15 cents at 25 or something else like that. And that's a problem that the industry has, and why your spread gets routed to spread book X on exchange Y. There's a lot of voodoo that goes into that behind the scenes there, Elliot. It goes into payment for order flow. The exchanges and the brokers, I should say, are paid by the market-making firms and liquidity providers to route things different ways. And there's all sorts of rebate schedules on these different exchanges. So there's a whole cottage industry of determining where these orders are routed to maximize the revenue stream. That doesn't always line up with the best interests of the customer out there. So I'm going to go out on a limb and say maybe this was a spread, in which case it wasn't lining up. Either way, if it's a spread or a single leg, you should contact your broker and say, hey, what's the deal with this? It's offered at 20 for more than 10. I'm trying to lift it for 10. What can we do? And if it is a spread, maybe you tell them, hey, move it to another exchange where it's lined up here, somewhere like that. And if it doesn't line up anywhere from a spread perspective, then maybe you have to consider paying a little bit more. Dan, is that your takeaway as well, sir? You think something else is afoot here?
Yeah, it's well, I just had a thought to add to what you were saying. Like getting how options get filled on exchanges is complicated. Like there's three things you never want to see made: laws, hot dogs, and option fills. It's a whole bunch of messy business. But yeah, if it's a spread, the thing is, one person could be trying to buy it and showing a bid on one exchange, but he doesn't want to sell the other option at the offer. Somebody else is trying to sell at the other offer. So there's no one person in the world who wants to trade that spread with you, even though it looks like you can do it. That, or maybe you didn't have it. And I don't know if you said that, Mark. I space out all the time when you're talking. No, I'm just kidding.
He's only half kidding, listeners.
No, but maybe you mentioned this, Mark, but you always want to make sure, even if it's a single leg, particularly, or any leg, you want to make sure that it's set to execute on NBBO. Like if you're just sending an order to the SIBO, maybe the ICE is offered and you're like, what the heck? I'm 20 bid, but you're 20 bid on the SIBO, and the guy in the ICE is like, man, I wish that guy would send the order here,
Yeah, there's a lot of voodoo that goes on behind the scenes. This kind of gets back to what we were saying earlier, too, about, understanding your brokerage platform and how they show you these types of quotes and whether they are reliable and whether you could actually get things done. particularly on a spread MBBO, whether you need to trade outside of it a little bit, or maybe the process for getting your order moved to another exchange where it can get filled. There's a lot of things that go into this. So I'm going to go out on a limb and guess, Elliot, that this was a spread. If it wasn't, hit us up. Let us know what the deal was with that and what ended up happening on this trade, because I am kind of curious. But usually if it's a single leg option, if you can hit a bid or lift an offer and you're doing that, you should be filled. So, interesting stuff. Let's see. We got time here for... Well, before we got that, Dan, I know you have a little bit more to add here on this mystery execution question, sir.
Oh, yeah. I was just wondering if this is the Elliot Benz that I know who lives in my town. If it is, hey, how you doing, Elliot? Haven't talked to you in a while. Hope everything's great. And if not, well, then, hey, Elliot, great to meet you.
Do you know Dan? Let us know. Your neighbor down the street writing into the show. That would certainly be cool, sir. All right. Unfortunately, with that tip of the hat to Dan's neighbor, we have come up against it here on yet another episode of Options Bootcamp. We could do so many just with your questions. Who was it who asked for the daily show? I forgot. Oh, it was Moogle. Moogle wanted it daily. We have enough questions to do that. Keep those questions coming. We do love to hear from you. If for some reason we can't make it into the Options Bootcamp show in a reasonable amount of time, I'll make sure it's routed somewhere else. You'll get your question answered fairly quickly. Don't you worry about that. Just don't leave the questions in like your iTunes review or something like that, because we don't get to those in a very timely fashion. So you'll be waiting for a little bit there. Send it to us on the platforms I mentioned, of course. You know, the social medias, the website, email, all that good stuff. And Mr. P, if they want to reach out to you to explore these or any other topics in the world of options, where should they go? What should they do?
Make your way over onto my little piece of the internet, markettaker.com, and we'd love to hear from you. We love nothing more than hearing from our listeners. So hit me up.
Yeah, and ask your neighbor what broker he's using to get that crappy fill. We should find out what's going on there. All right, good stuff. And on behalf of the Black-Hatted One and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in those questions. Keep them coming. We love to hear from you. Remember, if you like what you hear, keep those reviews coming as well. It's a bit of a symbiotic relationship here. You scratch our back. We scratch yours. Everyone's happy here. And we'll see you back here next week for another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.